Bring in David Nicholas, market watcher of this Tuesday morning. Jamie Dimon says the market, the JP Morgan says the market can handle higher yields. Do you think stocks can weather 3 or 4 rate hikes?
Well, Stuart, not all stocks are created equal, and it's something Lauren just said is right. What they said is that rising rates shouldn't be disruptive for stocks, but would support their call from the rotation from growth to value. So it's not that rising rates are great for all stocks. It's that if rates continue to rise, which I think they will, we will start to see investors get out of growth stocks, head over to value. And so that's what I think was the big takeaway from that. And so if you're an investor holding the bag, you don't want to be holding the bag on these names that have just gotten so detached from reality. Because we talked about it last week, Stuart. We said that we thought rates were going to 175. We hit it. I think rates are going to go to 2%. When that happens, I think it's going to be 2022 will be the year that free cash flows, meaning companies that actually are creating a profit, are going to be prioritized over growth. So you want to be owning those names this year.
So JP Morgan says buy the dip. Have you been buying the dip? Doesn't sound like you have.
Well, we're going to be rotating this week. But look, can Facebook, Amazon, Microsoft absorb the rising rates? Yes, you should buy those dips in those names. Can some of the tech names that have been so detached from reality absorb that dip? No. So we've got 3 themes this year that we're looking at: energy, financials, and reasonable tech. Those are the areas that you want to be buying the dip, and I think you'll be very profitable if you're buying in those 3 areas.
So it's not necessarily just go out and buy big tech on the dip. No. You want to rotate out of big tech. I'm trying to get to grips with this. Not buy the dip big tech, but rotate out of big tech. Is that it?
Stuart, that's exactly right. And if I can give you one of those sectors, energy, for example, we believe Omicron, hopefully the worst is behind us. That'll be great for all of us as Americans. But if that's the case, can you imagine what that'll do for travel this year? If international travel comes back, if corporate travel comes back, I think energy prices will be supported going forward. Anything above $80 a barrel for these energy companies, it's straight profit. So companies like ExxonMobil, HES, Occidental Petroleum, those are the names that if you want to have confidence buying names this year, energy is a great sector. One last tech name, ATVI, reasonable, trading at 18 times earnings. That's a tech name that I think you can get at a reasonable price.
Okay, let's talk about energy for a second. We've got a cold snap here in the Northeast, and it's going to last for some time. I got stuck in an ice storm on Sunday, by the way. So I presume, yeah, I did. So I presume that a cold winter is also good for energy stocks, which you're rotating into. Yes?
It is. And there's this crazy dichotomy happening, right? We've got clean energy like electric and solar coming on board. But what about this old dog energy? And I was looking at a report on energy. By 2050, clean energy sources will only support about 50% of the world's energy needs. So, Stuart, oil is not going away. We've got another 25, 30 years where oil will still be a big part of our daily lives. So I think we can confidently be buying some of these energy names and know that they're going to be providing profits for years to come.
Okay, by the way, oil just went to $80 a barrel as you were speaking. Yeah, right. Okay, gotcha. David, thanks for joining us. See you again real soon. Next.